Okay, are we good now? I've received
Yes.
the link you sent.
Yes. So the meeting is open for anyone that wants to join, and I forwarded the YouTube link likewise. So
Okay.
that's fine.
You
I'll
are
leave the
calling
meeting.
me or
No, it's
you
just
are
a
calling me
message.
on WhatsApp?
No, just a message. Just a
All right.
message. Okay, it's an error. Just a
Okay.
message.
Thank you very much. I appreciate it. Thank
All
you.
right, take care. Thanks.
Okay. Good evening, guys.
Good evening, sir.
The call back to you. Yeah. Okay, so let me share my screen. So can you guys see my screen now? You can see my screen, yeah? Okay, that's good. Okay. So please, who can remind me where we stopped the last time? Network, I think I had a network failure. And then by the time I was able to join back, all of you are taking off with just very few persons left. So I just decided I don't want to leave too many people behind. So I ended the class that day. So we are going to pick up from there. But then it brings my attention to situations like that. If I leave the class unexpectedly, you should understand that it's network or something. So maybe you just give it some 10-15 minutes to hear from me. If I'm going to end the class, I will surely leave it with a goodbye and all those kind of pleasantries, instead of just jumping out. Except you are tired and you want to sleep, fine. But with the way people jumped out of the class, I felt like waiting they happen. Okay, that said, we don't have much time. We wasted a lot of time because of the
We
issues
are
I have
very
with
sorry.
my
We are
phone.
very sorry. You should not repeat
No,
the
it's
same.
not a problem. I'm just saying, in case of next time, let's just you don't really need to apologize. I understand, but a little more patience. Okay, that's what I'm calling for. So, who can remind me where we stopped? I think we've not gotten to put call parity. We're still discussing the option strategies, right? We're still discussing the option strategies. Please, who can remind me? So we just pick up from there. Or you guys, you just close your notes after the class. Okay. So I want somebody to explain synthetic long call, this option strategy 3. The synthetic long call, that's where I'm going to start from. I'm going to assume I've explained that part before. So I want somebody to just pick it up. You can see my notes. Let me zoom out. And again, I want to apologize. Somebody called my attention to something midweek. He said for those that are using the YouTube link, that you guys are unable to see my screen, especially on Excel. You're unable to see whatever I'm computing on Excel properly. I apologize, I didn't know. So from today, I promise you, I will do my best to ensure that you have time, right? I'll do my best to ensure that I zoom out my screen, my Excel. While I'm waiting for somebody, anybody, please explain option strategy 3. It's there on my this thing, because I'd like to believe that whatever we are doing here, we are picking it up. So somebody just explain it for me, please. It's here. Synthetic long call. You can read it, explain what you understand. Somebody just save us time. We've already wasted enough time. So I'll be done with this class by 11:30. Started by 9:30. I'm waiting. Anybody, please don't be embarrassed. Just tell me. That is how I will know that, okay, you guys were picking something or you were doing something. Or you can't hear me. Can you guys hear me? Synthetic long call. Wow. Nobody want to even give it a try. If you are wrong, you will learn from your mistake. It just tells me that, okay, after the class, you guys just shut your notes. Maybe 1 or 2 persons go back to read. I know it's a lot of work, right? SFM on its own is something you can read for the whole diet. Then you still have other topics, other subjects you need to study too. It's a lot of work, but come on, you need to put in the effort. Try, push yourself. That said, judging by what I'm saying, I will just assume that even if I go back to the second strategy, yes, nobody will be able to explain it to me. So I'm just going to start from synthetic long call, explain, and go forward. Today I'm looking at getting to futures contracts. Next week we continue with futures, we go to swap, and then we move on like that. So the synthetic long call. A synthetic long call means there is somebody's mic that is on. Please, I'm not the what, how will I call it?
Amalola, please, can you mute your
I'm
mic?
not the administrator of this class. I'm not the admin, right? I was not the one that set the meeting up, so I can't mute you. So please, let's just help us and mute ourselves, okay? Please don't make me call your name or something. Okay, so the synthetic long call, we're looking at the option strategies, and I told you these are synthetic contracts, right? So you are mixing your synthetic contract, you are mixing your options contract, and you also have a position in the assets, right? So in synthetic long call means you create the same payoff as buying a call option without actually buying it. How do you do it? The formula is that you long the stock. That means the stock you are holding, you are longing it. So you make profit when the stock increases, right? And you also long a put. Therefore, if you buy the stock and you buy a protective put, your position behaves exactly like a call option. So what do we mean by a protective put? You are buying the put to protect the downside, right? If the if the asset value falls, the put option gives you the right to sell. So you buy the put, you buy the asset. So you buy the asset, you buy the put, and then the put gives you the protection if the asset price drops, right? So you sell it, you take whatever, from a put you gain. You gain when the asset is falling, when the asset is falling in price, right? That is when you make a profit. So the profit that you will make from that put option will be equivalent to the loss that you would have made from holding that asset. So you use that profit to net off the loss that you would have made from holding that asset. And by so doing, you would have protected yourself from losing. The potential loss that you will incur maybe might be your premium that you paid, which in this case might be insignificant because you have actually used that put option to secure or safeguard yourself from a huge amount of loss. That is what the synthetic long call is. This is as simple as this, right? So the example set up numbers as before. So I believe we've stated the whole example previously. Say you buy one share of XYZ stock at $50. You buy one put option. Now the put option, the strike price is 50, right? That is how much you buy, and you pay a premium of 2 naira. This is the protective put, which is the synthetic long call. Outcome: if the stock please, anybody that wants to leave their camera on, I don't have a problem. I saw a comment. I don't have a problem with leaving your camera on. If you want to show us your fine face, it's fine. But please don't show us things we don't want to see. That's just what I would say. But if you want to leave your camera on, it's fine. But I think it would be better if you just mute it for your own privacy. Just close it down, right? It's not necessary, but if you choose so, it's fine. Okay, let's continue. So yeah, it's actually causing a distraction, right? Especially for our single guys, single ladies leaving their cameras on might distract the single brothers and vice versa. So please, I'm kidding, but all right, let's just continue. So so the asset goes up to $60. If it goes up to $60, your asset, the asset you are holding, increases, right? You are making profit on it. Because you are making profit, your put option will be worthless. So because you don't want to exercise a put when the asset is going on, so your put is worthless. You buy the asset, you discard the put, right? So in that case, you only lose your $2 premium. So your net profit is the $10 that you would have gained because the asset increased to 60 minus the $2 that you spent for the premium. So you have a profit of 8. Now, if the stock stays at 50, it stays at 50, your put is still option, your put option is still worthless. So you still have a profit, a loss of $2 premium. If it falls to 40, your put gains 10. The assets you are holding, you lose 10. Your put gains 10. The asset you are holding, you lose 10. So the 10 you gain from the put minus what you paid from the put is equals to 8, right? Is equals to 8. Now you use that 8 to go and offset the 10 loss that you have incurred from holding the asset. So the actual loss there is just that $2 that you lost from the premium. This is very simple, and it's the same way it applies to the other two strategies that was explained last week, right? The earlier two. And they just reflect different positions, whether you are shorting the asset and you are buying a call and whatever, you have a target, you are only protecting your position, right? So the collar strategy is the same thing, is the same objective. You are protecting your position. However, with the collar, you are buying a put, you are buying a call, right? Sorry, you have a put, you have a call, you buy the call, and you own the stock, you sell a call option. So by selling a call option, what does that give you? Somebody should tell me. When you sell a call option, what does that give you?
You are going to sell.
Eh?
You are agreeing to sell.
You sell a call. You are agreeing to sell. Is that correct?
The price
Somebody
is high.
else. Omolola,
It shows that the price is high. In the
No,
market.
that's not the listen. When you sell a call option, what happens?
Like you are
What
agreeing with
happens?
someone to buy, like you are agreeing with someone to buy the stock from you.
Olayinka, you
It's
are
an
almost there, but
obligation.
Right.
you
Hello?
are confusing, you are mixing things up. And I want you guys to use the right term, right? Agreeing is fine, but I want you to use the right term. Like you have a right or you have an obligation, things like that. You
You are
get?
selling the right. You are
Exercising your
selling the
right.
right option.
You are exercising
You
the
have
right
an
to sell.
obligation. You have an obligation.
You have an obligation. That's the word I wanted to hear. So because you sold a call option. A call option gives the call holder the right to buy, right? So you that sold the call option, you have the obligation to sell. So when the person comes to buy, when he exercises his option, you have an obligation. The person have an option. So you can do or not do, but you have an obligation you must do. You get? These things,
Hello, sir.
please have it in mind. Yes, I'm with you.
So in this case, what is the difference between the rights and obligations?
Sorry, your full name is Ashigili. Sorry, I don't want to
Yes,
pronounce
sir.
it wrong. Is that correct?
Yes, sir.
Let me see. Who can answer that question for me?
Because from the explanation, I
Abraham.
got that call option is when you have the right to buy, not obligations. So now you are referring it to be an obligations, because if you have an obligations, it's a responsibilities, it's a liabilities on you, on your side.
Okay. You know why I want to recognize your name, because I think I'm a bit familiar with people that have attended my class very well. I'm not saying you have not attended my class, but probably you've been joining on YouTube, because I'm just seeing your name for the first time, but it's cool. I wanted to know if you have been following this class from the very beginning, or maybe after the first or second class. Because if you were, you would have been very familiar with what we are saying. Now, a call option, I don't want to start teaching this thing now, but I will explain it to you. A call option gives you the right to buy. You have the call option. Now we have the writer. The writer is the person that is selling the option. So if I'm selling an option, think of the option as a property. Let me say the option is a laptop. if I am selling my laptop and that laptop is a call option, what I have sold to you is the right to buy. That laptop that I've given to you gives you the right to buy. You get? And if it gives you the right to buy the underlying asset, that means I have the obligation to sell when you want to exercise that option. Does that make sense to you, Abraham?
Yes, sir.
So this is where the two parties come in as to who is buying and who is selling. You get? So these are the two options that we have. So when they say you sell a call, you are giving somebody the right to buy and you have the obligation. Now, back to what we are saying. I wanted to ensure that you guys are still with me in this class, but it seems I'm alone but it's all right. It's good. You'll catch up. So when you are using the collar strategy, you know the other of the previous three we discussed is either you are buying a put or you are buying the call or something. Now in this case, you are combining three things. You are combining a put option, you are combining a call option, you are also adding the asset. So now what is the aim of this collar strategy? The first thing that you want to eliminate is the loss. You know, when we discussed the other one, the long put and the long call and all those things, the protective put, when we discuss that, we say at the end of the day, you are either losing your you are losing your, what is it called, your premium. That is what you are doing. You are losing the premium. We are not losing it, so that whatever loss you are making will be guarded. Now, how does this work? You own the stock, right? That's the first thing. You buy a put option. That means if you buy a put option, you have the option to sell the call. You are also going to receive a premium. So the premium paid for buying the put and the premium received for selling the call should be equal. So in that way, you have cut off that loss, that potential loss that you would have made. Am I making sense?
Yes, sir.
Have I succeeded in explaining something, or I am confusing you guys? Please, I want one person to tell me that I've confused you so that I will explain again.
At a
Okay,
certain
so
point,
everybody
your
is
voice
fine.
You
went
have
off.
confused me, sir.
I have confused you. Who are you that I
At a
confused?
certain
Tell me
point,
then.
your voice went off.
My
Hello,
voice
sir.
went off. Okay, my voice is back.
Hello, sir.
Juliet, is that you that I confused? Yes, I'm with you.
Yes, sir.
Hello. I think what I understand is that instead of losing premium on these strategies, we use the
Isiak,
premium that
Isiak,
Isaac,
sorry, your name. Let me. Eh?
Isaac,
Jimo, right?
yeah,
Jimo,
Jima
I
Isaac.
think there is
Yeah,
the noise in your background. There is a noise in your
and then
background. I can't hear you clearly.
maybe network. This place is very silent. I'm
It's
the only one
network,
here.
right? Okay,
It may be a
try to
network.
be a bit more audible.
Okay,
Speak
what
out
I'm
a
trying
bit.
to say. Hello, sir. Can you hear me now?
Go on. Go on.
Okay, what I understand is that on these strategies, we use the premium that we lose on the call option to settle with premium that we gain on the sell call option. That is, there is no loss, there is no gain.
On that premium, yes.
Yes.
So on the premium, the two premiums for buying the call and selling the buying
Selling
the
the
put
call,
and selling the call, those two
call
premium
okay.
cancels out. You get. So you have succeeded in terminating any potential loss that could accrue as a result of that premium. You know, the previous ones we explained, you say you end up losing
Yes,
only
yes.
the premium. So now
The
the
premium, yes.
premium has been that
Settled.
loss has been taken care of. Juliet,
Yes.
over to you. In what area or in what way am I confusing you?
So in between your conversation, your line was breaking. I don't know if it was my network, but I think I understood from what the
Okay,
previous
I
person.
think it's your network.
Only
No, it's not our network. Your
It's
line
not,
was breaking and
your
it
line
went off
went
at
off.
some point.
It's
Okay, but you
general.
can
Your
hear me
line
now,
went
right?
off. Yes, sir.
Yes, you can hear
Yeah,
you
but you
well.
can hear me now. Okay, sorry. That's what I've been dealing with, and it's part of the reason why we delayed the class. Someone else had to schedule it, but I'm just hopeful that we'll be able to conclude today. Sorry about that. If Juliet says she's fine, so we are all good. So I'll just continue. Let's fire down. So let's look at this setup. An example. Excuse me, I need to have a drink, water or something. I'm coming. Okay, I'm back. So let's look at this example. You buy one share at $50, right? You buy the put $50 and you also pay the premium $2. This is where I am on the note. You pay the premium $2. So this protects your downside, right? Now you sell the call. You sell the call. Now, so if you sell the call, this call gives you the obligation to buy, right? And you will buy if the asset increases. Now, the logic, let me paint it from here before we go further. So the logic is that you bought the put. If the asset is falling, remember this $2 here is canceling out the $2 here. So we are not taking that into consideration, right? So you bought this asset, you expect to make profit from the upside. So if the asset is going up, you are making profit, right? You bought a put. So this put that is protecting your downside. So if the asset is going down, you exercise your option because your put will be making profit for you. If the asset is going down, your put will be making profit for you, but your asset here will be losing, right? And what will happen? Because you sold a call, when the asset is going down, the call option holder will not exercise his call option because he will be losing if he exercises it. So the call in this case will be knocked out. Do you get the idea? So your put protects your downside here. Now, in the other scenario, the asset is going up. The asset is going up. You are making money from here. because you are making money from here, your put option is losing. So you as a put option holder, you have no reason to exercise your put option because you are losing. However, the call option holder has a reason to exercise his call option because he will be gaining, right? So what will he do? He exercise that call option. You buy the call option. You buy the call option using the money that you have gained from here to buy the call option. You understand? So what has this guaranteed you? What is the main aim? Now you are in every scenario in the two situations I've explained where you either need to exercise your put or the call option exercises is call. In every of this situation, you end up owning that asset. You end up owning the asset because you have to buy the call if the asset is increasing. So the man will sell his call to you, so you are holding it. But if the asset is falling, you would have exercised your put and use that put to the gain from that put to gain to net off whatever loss you are incurring from the loss of owning the asset. So in every situation, you just want to ensure that you own the asset. So you are not going to gain too much, you are not going to lose too much, but your target is to own that asset. So you don't want to be in a position where you are owning that asset and losing. Or you don't want to sell when the asset is falling and then later it increases again. You just want to ensure that you are owning that asset. So this is what your collar strategy gives you, right? So in every situation, your net option, your premium cancels out to zero. Am I making sense? This thing is on. Please help me. Okay. So let's look at the potential outcomes here. Let's look at the options, the outcomes here. At expiration, stock goes up to $60. If the stock goes up to $60, what happens? Who can explain? So with everything I have explained, I just need you guys to be telling me. Let's teach each other. I might be in a position where I just pick names randomly because it seems you guys are not answering me, and I want to ensure that we are talking to each other. We are understanding this thing. So let somebody explain this first possibility, this first outcome here. If the stock, the explanation is even here, so you can be looking at it. But I want somebody else to talk. I'm thinking water too much. So tell me.
Hello.
Yes, go ahead, Jimo.
Yeah. If the price is $60, you are gaining 50 naira from the asset. And you are not exercise.
Now, one thing I want you guys to take note of. Sorry, Jimo, hold on. I just saw something. I think I might have missed it. So now, if you look at it, if you look at the strike price of the call option and the strike price of the put option, they are different. One is $50, the other one is 55, right? The call is 55. So if the person exercises his call, you buy at 55. So your actual gain on the call, the gain you might make on the call is $5, not $10, like I mentioned earlier. So continue, Jimo. Continue, Jimo.
Okay. So he's holding the share by gaining 10 naira because he buy a share at 50 naira and the price of the share is 60 naira. If they sell, he will gain 10. So he don't need to exercise the put strike again because if he strike, is losing. So he need to exercise the call strike to buy another stock because he's gaining another 15 naira there.
No, he's not exercising. He's not exercising the call. He doesn't have the right to exercise the call. He sold the call, don't forget. Olainka, go ahead.
So good evening, sir. So the way I understand this thing is that first of all, the individual bought the share for $50, right? So in order not to lose, he agreed with someone that is going to buy a put option that is going to sell, and he's going to he exercise with someone that he buy a put with someone that is going to strike 15 naira. If in case the option is decreasing, in order to be at a silver side. So in the next scenario, he agreed to sell a call to someone because when the shares is increasing. So in order to just balance himself. So now going down to the scenario, now we are in the case whereby the stock price has gone up to 16 naira. So when the stock price now is in 16 naira, the person is not going to exercise that put option because he's going to lose. It's just like when you bought something at the rate of 15 naira, the current price of that item now is 16 naira. So you are not going to sell it because you've agreed with someone that you are going to sell. I don't know, maybe you understand the way I said it. You are not going to sell it because you've agreed with someone that you are
I
going to
get you.
sell at
Go
the rate of
ahead.
15 naira. Because if you sell, you are going to lose that 10 naira because the current market price, the lowest price that you can buy that item is 16 naira. So you are not going to sell because, okay, fine. You know, when you sell it, they are selling this thing at the rate of 16 naira. So now going back to the second option, the person that you've agreed with that, okay, you should come and buy it at the rate of 55 naira will likely come because the person is not going to see that item at the rate of 55 naira in the market elsewhere apart from your side. So the person will come to exercise his or her call option. So during that period, because I have bought that item at the rate of 15 naira earlier, so I'm going to gain 5 naira, not considering the price in the market. So because I bought it at the rate of 15 naira, so the person I'm going to gain 5 naira because the person will actually exercise this call option and buy it at the rate of 55 naira from my own hand. So I'm going to gain 5 naira. So now when I was doing the agreement with the person that I'm going to sell to the person has paid a premium of 2 naira to me, $2 to me. So it's going to cancel out the $2 premium that I have also agreed with someone that I'm going to sell to the person. So at the end of the day, I'm going to get just $50.
$5. God bless you,
Yeah, I'm going to
Olayinka.
get $5.
So Jimo, that was why I stopped you. Yes, that was why I stopped you. You as the call seller, you are not the one exercising. It is the person that is gaining and holding the call that we exercise. You need to understand these little things, but you were not too far away. That was just, Olayinka, thank you. That was a perfect explanation. I'm very fine with that. So we don't have much time. I just wanted to ensure that I'm seeing a lot of hands up. Sorry, I will not call all of you because of time, right? If you can see, this is where we are. And I have a whole lot of things. I'm dragging my notes down. You see, a whole lot of things. So I want to teach put call parity and we go to forward contracts today. We have to achieve that. Okay. So sorry, I won't be calling all of you. So I think this is where we are. So so the upside is capped at 55 strike price. Stock stays at 50. If the stock stays at 50, everything is worthless, right? So you just hold your stock. Nobody exercises any. If it falls to 40, you have the right to exercise your put. The call option holder does not exercise his call. So if you exercise your put, right? So you gain $10. So you use that $10 to net off the loss that you would have made from holding the asset, and your net profit is zero. Your downside, which is what the loss you would have made, is protected at $50. Does this make sense? Is anybody confused? I think this is our everyday life, right? Is what we do every day from normal our everyday life. It's something that even the market women can easily compute. It's just English that is making it look like it's one big thing. You get, it's not that difficult. So I think we are fine. Any question before I proceed? Question? Okay, we are good. Selling insurance. So let me just explain the covered call and covered writing. If you have a position in an asset, if you have a position in an asset and you are selling an option in that asset, it is called a covered writing, right? If you have a position in an asset and you are also selling an option on that asset, it's called a covered writing. Now, if you don't have a position on an asset and you are going to trade on the option of that asset, it is called a naked writing, right? That's what this place is just explaining. We can expect that some investors want to purchase options. However, for every option buyer, there must be an option seller. It is possible, of course, for an investor to simply sell calls and puts. Often, however, investors also have a position in the asset when they sell the options, which is an insurance, right? Writing an option, that is when we say writing an option, I've told you it means selling the option, right? Writing an option when there is a corresponding long position in the underlying asset is called covered writing. Option overwriting, okay, so it's called covered writing, option overwriting, or selling a covered call, right? But just know it as covered writing. All these other English, they are not too. This is the most popular that is used, covered writing, right? All three terms means essentially the same thing. In contrast, naked writing occurs when the writer of an option does not have a position in the asset. A covered put is achieved by writing a put against a short position on the index. So it means that you are selling a put and you also have a short position on the asset, right? You don't want to lose too much. That's what this situation is giving you. The written put obligation obligates you to buy the index for a loss if it goes down in prices. Thus, for index prices below the strike price, the loss on the written put offsets the short stock. So I believe this is clear. So let's go to put call parity. I know a lot of us have been hearing of the word put call parity. But what does it actually mean? Can anybody help me? I believe you have these notes. You have this note. That's why I give you the notes, like, so that you can read. And even if maybe I'm unable to explain it here in the class, I believe Ahmad, please put off your video. You are distracting me in particular. Ahmad, okay, continue. So the put call parity. I give you notes so you read. So if anybody have read this put call parity, don't be shy. Don't be shy. Explain. Tell me. If you are wrong, I will correct you. So who can tell me what you understand by the put call parity? I'm waiting. You should have read ahead of your class so that you drop questions for me. I'm waiting. Oh. Nobody. That's bad.
I'm raising my hand.
Whose hand is up? Ife, thank you very much, Ife. You are my person. All right, continue. Go ahead. Let me hear you. What do you think the put call parity? What, you don't need to explain everything. Just give me your idea.
From what
It
I can
relates to
see,
everything we've been learning. Yeah.
from what I can see here is a scenario whereby both the put option and the call option have the same strike price and expiration date, but then they have different premiums. So as they have different premiums, surely there will either be a loss or there will be a gain. like the last one we treated, whereby they have same premium, it kind of stroke out every chances of loss that was supposed to be experienced. But in this case, they are not, the premium are not the same, but the strike price and the expiration are the same.
Okay, thank you, Ife. I'm glad you've given us. I'm glad you've made an attempt. So it means that if I tell you one or two things, you will grab it. That's the whole idea. Olayinka, okay. Olayinka, tell us. Unmute yourself and tell us. I think there is somebody else, Juliet Adams. Okay, after Olayinka, Juliet, after Juliet Adams, the three of you, just give me your explanations. Then we'll continue. Quickly, please. Each of you have 2 minutes. Olayinka.
No, I'm not raising up my hand. Sorry, I forgot to drop down my hand earlier.
I thought I saw your hand. Oh, you
No,
forgot
no,
to
no.
drop your hand. Oh, yeah, drop it.
Yes, that's right.
For your hand, my guy. I don't mean for your hand, though. I'm just joking. All right, Juliet, your hand is up.
So I was just
Have you
saying
two, you
my
forgot
own.
to drop your hand?
No,
Eh?
sir. No, sir.
You
I
forgot
want
to
to say
drop your hand.
something. No, I
Okay,
want
go
to say
ahead.
something. So
Okay, go
in my
ahead.
own
I'm waiting.
understanding, I would say it's when the put option and the call option are the same contract, same strike, they're trying to say, but the future contract is different.
Okay,
Do you
no
understand?
problem. You have tried. You have
Okay.
tried. Well done. Thank you. Okay, I think there was one more person, but it seems to he forgot to drop his hand. It's fine. Okay. So with the put call option,
Sir.
we are trying to achieve
Hello?
something. Yes,
Hello?
yes, I'm with you. Yes, I'm with you, Adams. Right?
Oh,
Adams, yes.
yes.
I can hear
Yes.
you, Adams. Go ahead.
So I think what we meant by put call parity is when the net cost of buying an index at a future date, so using the option must be equal to the net cost of that buying of the index. So through using a future contract, so as in the net cost of buying an index, so an option in the future date, it must be equal to the net cost of that the net cost of that index as a future date through a future contract. So
Adams, thank you. Thank you very much. You are not far from
hello, sir.
Okay, you are Adams. I like your explanation. You made a lot of sense, but I think I'm the only one that understand where you are going. Maybe other persons, but from where I'm sitting, I just feel okay. I understand where you are going, but I would like to put it in a simpler way for others to understand. We have Ibrahim. Your speaker is up. If you want to talk, mute yourself, please. There's a cute voice in your background. Okay, that he has muted. All right. Okay. Okay, so when we talk about put call parity, Adams, you have a good point. You have I think you have the insight into what you want to explain, but let me make it a little bit easier for people, for others to understand. Outside the note, if you are looking at the put call option, you are comparing two different ways to get the same results. I've explained something about arbitrage pricing to you, and arbitrage, I've explained it exists in a situation where the market is not in the best position, right? So we have different prices at different markets, and then people tend to make please excuse me, guys. Sorry about that, please. Um, so you have this situation where the market is not in the best position, right? And then people spot these lapses and take advantage of it. So what the put call parity does is that it tries to check for pricing consistency. It tries to ensure that in different markets, what you have as the put option price and the call option price are equal. That is consistency. So it makes sure that no one is overpaying. No one is overpaying for any option. So what you are buying a call option for gold, let's say you are buying a commodity option. What you are buying, if you are a call option for gold in Nigeria market, that will be the same price of a call option for gold in the US market. That is what will be the call option for gold in whatever country market. That is the put call parity is there to ensure this consistency. Then it spots the risk-free opportunities, which are the same thing as arbitrage. It's the same thing I just explained now, but the whole idea is that the put call option spots the risk-free opportunities. So from what Adams was explaining, that by saying that I didn't get what you were saying clearly, because I think there was a bit of noise in your environment or your network or something. I get where you were driving at. So when you are saying you are trying to ensure that the put is equal to the call or something like that, that is the whole goal. That is the whole goal. So when you see questions related to put call options, they will be asking you to check if there is a put call parity. If put call parity exists in the market. If it doesn't exist, so if you have a question and the put call option and the put call parity does not exist in the market, maybe you solve to the end and you see that your put call parity does not exist, it's telling you that there is an opportunity for arbitrage trading in that market or for that particular commodity. Am I making sense? If it does not exist, it tells you that there is an opportunity for people to exploit that market if they do their research properly. So by the time you take the put parity from one market and you are comparing it to another market, you should be able to arrive at the same answers, given the formula that we are going to explain to you. Is this ABC enough? Tell me. Only if is responding. Chindindu. Okay. So that is what we are planning to achieve. We want to ensure consistency. We want to ensure that arbitrage is limited as much as possible. And we want to ensure that there is fairness in the market. So there are different sides to the put call equation. We have, okay, go ahead. Olayinka, your hand is up. My guy. Olayinka, you put your hand down back again. Okay. So we now discuss the put call parity, which is one of the most important relationship in the theory of options. The parity equation tells us the difference in the premiums of puts and calls when the two options have the same strike price and time to expiration. But before we understand the put call option, Now, what I want you to explain and what I want you to understand is that if you are looking at put call option, because I know most of you will do your own research, you go and read other books, you might see a different option from the formula. From the formula, I'm going to, ouch. Somebody say my voice is breaking. Please, I need like 3 persons to confirm this too.
It's not
Is my voice
breaking.
breaking?
Your voice is
No.
It's
fine.
not breaking. That means, okay, that means it's his network. Okay. So please, Ali or something. Please confirm from your end. So let's look at synthetic forwards. Or something. Sorry, I was explaining something before that. I'm saying that some of you might go and do your own research, which is totally fine. You can go and find out and all that. So you see different formulas. You might see a different formula from what I'm going to show you here, but the formula you will see and the one that is here, if you apply them the same way, you should arrive at the same answer. The difference is that one of them might be the spot formula. They might give you the spot formula, but the one I brought into my this, which is this, into my notes, is the formula for a forward, right? Is the formula for a forward price when you have the risk-free rate. The spot formula is very easy. You just have the call premium minus the put premium is equal to the spot price minus the strike price. That one is fine. But if you look at this formula, you still have the same thing. But we'll get to this place. I'm just trying to tell you that in case you are looking at a note now, or you go and search and you see something that is different, just know that they are saying the same. They are the same thing. It's just about application, how you apply them, and what is given to you in that question, right? The data available to you. If you have the forward rate, use this formula. If you have the spot price, use that one, that other one. I might be gracious enough to even put it here some other time, but for now, this is what we have. So let's look at synthetic forwards. A forward contract obligates you to buy directly. A forward contract obligates you, right? So with the forward contract, we are obligated to buy. You don't have an option. When that particular day reach, that the date that you guys, the maturity that you guys agree, you must buy, right? Whether the asset is going high or coming on down, it's not like the option contracts that we say, okay, you have an option to buy or not. Forward obligates you. However, when you are using synthetic forwards are not forward contracts in the sense of the word forward. They are put options and call options. What we call synthetic forwards, they are options in the form of put and call, but you combine them in such a way that as at that particular day, you are obligated to still buy. Am I making sense? A forward contract obligates you to buy. But when you are not using a forward contract to buy, rather you use an option contract to go into that deal. You set the option in such a way that you either buy, not either, you are going to buy, right? So indirectly, a synthetic forward. So why the word synthetic in this scenario now? Synthetic is coming in because you are not using a forward contract. You are using options, right? So synthetic forwards obligates you indirectly. Why is it indirect? Because with options as the option holder, you are not obligated. You have a right, right? It's the writer or the seller that is obligated. So it obligates you to indirectly through the combination of a call or plus a put. A synthetic forward is when you create the same payoff as a forward contract by using options. You buy a call at a strike price K and you sell the put. So, okay, there is an example here. I wanted to think of something and explain, but let's just use this example. This combination mimics a long forward, right? So let's look at it. If you buy a 6-month call with a strike price of 1,000 for $93.8, this $93.8 here represents your premium, right? And then you sell a put. So by buying the call, you have the option to buy. And you sell a put. Look at the strike price of the call option and the put option. You are selling the put, which gives you the obligation. The call gives you the rights because you bought it. The put gives you the obligation because you are selling it. You see, they are both the same thing, right? Okay. So your net cost is 19.61, right? The net cost is 19.61. How did you arrive at 19.61? My calculator is here. 93.8 minus 74.2. So this is how we arrived at the 19.61, right? So if the index falls to 900, the put buyer will be gaining 100 naira. 100, is it naira or dollars? Okay, it's dollar. You'll be gaining $100, right? So you will be in a position to do what? Exercise this put. So you will be gaining 100 naira. So you are obligated to buy at 1,000. If the index rises to 1,100, you exercise your call and you gain 100 naira. You exercise the call, you also buy at 1,000. Either way, you end up buying the assets at 1,000, just like a forward contract. Do you understand the way the synthetic forward works? So you set both the put and the call at the same strike price. Now, either way, you are going to buy that asset, right? So depending on how you even negotiate, you might be gaining, you might be losing, or you might break even, depending on how you negotiate on the premium, right? So in this case, you are losing this 19.61 because you bought the call option, right? And you paid this money. So, and you paid 93, which is higher than what you received for selling the put, right? So you are losing this. But if you are good in negotiation, you can even make a gain from this. But the whole idea is to make sure that you indirectly obligate yourself to buy that asset using options rather than a forward contract, right? So the key difference from real option: forward contract has no upfront cost, right? Synthetic forward costs the net option, which is the call minus the put. In a forward, you pay the forward price, which is the price as at the expiration date, right? In a synthetic forward, you pay the strike price. So this is just the difference. So this number 2 is not really significant, in my opinion, but I'm just putting it here in case you need to understand. This is where the major difference comes between using options and options to set yourself up for an obligation to buy a contract, and using a real forward contract, right? Is the difference is in the premium. So now the put call parity equation. I'll explain what we aim to achieve, right? What we aim to achieve. Now let's look at I'm scrolling down to see if we have an example here. Okay, we have example. We have an example. Okay. So we can summarize this argument by saying that the cost of buying the index at a future date using the options must equal the cost of buying the index using a forward contract. Do we agree with this statement here? 1 or 2%, just tell me. Do we agree? So this statement here is simply saying that regardless of whether you use the forward contract or you use the Bolanle, say not clear. Bolanle, tell me what is not clear, please. Bolanle, come in, unmute yourself and tell me what is not clear. I want to hear your voice.
Good evening, sir. Sorry, I was actually
evening,
lost
Bolanle.
out by the I was actually lost out by the network, so I just came in back.
Okay. Okay, that will be taking us back, but it depends on where you got lost. Where are we going to pick you up from now? Tell me, where are you lost?
From the aspect where you were mentioning the parity and forward contract.
So you are talking about the synthetic contracts, right? The synthetic forward contract.
Yes.
Okay, stay on the call. Don't unmute yourself. Then don't mute yourself. So what we are simply saying is that when you are using a real forward contract, is an obligation. You have to buy whether you are gaining or losing. Do you agree?
Yes.
That is the real forward. Yes. You have an obligation. You have to buy the asset as at that particular day, right? You have to buy the asset. That's the forward contract.
Yes.
Buy or sell the asset. That's the forward contract. Now we are now saying when you are using options to set yourself in a position that gives you
Yes, I knew about that.
Yes, but what I'm saying is that when you use options to obligate yourself, not directly like a forward contract, you use option to obligate yourself to buy an asset as at a particular time. Get the difference. Now I know that from what I've been explaining, options give you options and all those things, but now you are using an option to obligate you are positioning yourself in a way that you have to buy that asset on that particular day. It is called a synthetic forward. Now we look at this example. What did you do, Bolanle, when you went to the market? You bought a call option. That call option gave you the option to buy, right? You set the strike price at 1,000. You paid 93 naira as the premium. You also went to sell a put on that option. By selling the put, you received 74 naira, right, for premium, and you agreed that the put price will be 1,000.
1,000.
Right? The strike price for the put. So the net cost, that means what has this whole buying and selling of call and puts respectively, what has it really cost you? If you do how much you pay to buy the call and how much you receive to sell the puts, you did the difference, you have 19 naira, which is $19, which is your this thing, your net cost, right?
Yes.
So the put buyer sells to you. So now we know that if the price fall, because you sold the put, you have an obligation, right? You sold the put, you have an obligation. The put buyer will exercise his option when the asset is falling. So the asset fell to 900. The put buyer exercises his option. So you buy the asset at 1,000, right? That has given you the obligation indirectly. Do you agree with me?
Yeah.
To buy the asset at 1,000. Indirectly, it has given you the option, obligation. So now the option, the asset increased to 1,000. When the asset increased to 1,000, sorry, the asset increased to 1,100 here. This has given you, as the call holder, it has given you the motivation to exercise. It has given you the motivation as a call holder to exercise your option, right?
Okay.
So you exercise your option for 1,100. You exercise your option at 100,000. So, or 1,000. Some
1,000.
the call seller is now obligated to give you that asset. So you now buy the asset as 1,000 and you are gaining 1,100. Do you understand? So the two situation gives you the indirect obligation. That's what we have just explained with synthetic forward. Do you get the point?
Yes, sir.
So I came further and I explained that the only difference between synthetic forwards and normal forward is the difference between the call option premium and the put option premium, because with a forward contract, you don't pay anything initially. You just go into the contract. You just agree that contract. But with a put option, with an option contract, you have to pay that premium. Do you get? So this is the major difference. So now we came here back to where we were. I hope everybody is along, has catch up with us now. So we can say from what we have explained, we can summarize this argument by saying that the net cost of buying the index at a future date using option must equal the net cost of buying the index using the forward contract. So this is the idea of the put call parity. If at time zero, you are SFM students, right? So you know what we mean by time zero, current time. If at time zero, we enter into a forward position, a long forward position, which will expire at time T, for example, 6 months time, we obligate ourselves to buy the index at the forward price. So this is what we use to denote the forward price, right? At time T. We obligate ourselves to buy the index at this forward price at time T. The present value of buying the index in the future, is just the present value of buying the forward price, which is equal to this. So what I'm trying to do here now is break down this formula for you, right? So now what this thing is saying, what this explanation here is saying is that if you have agreed, to go into a forward contract, right? You have agreed to go into a forward contract. It means that you agreed today, which is time zero, right? And you are paying that money in the future. First thing you need to do is bring the forward price from that future to today. That is the present value of that forward contract. Sorry, I'm reading somebody's this thing. Sir, please, can this forward contract be used to hedge against inflation or FX flotation for buying of raw materials? That's the whole idea of hedging. So every derivative contract they can be used to hedge, right? And that's where we are going. Olanle, I got your question. Sorry, Baker Comfort. Yes. So your question is right. The answer to your question is yes. Forward contracts can be used for hedging. In fact, that's what one of the main reasons, one of the reasons why derivatives are there. You use them to hedge. It's just that you have to understand what your objective of going into that contract is. If you want to hedge, what are you hedging against? How? So we'll look at it. I'm hoping that maybe from next week we'll start. If we are able to finish futures today, from next week we'll go into commodity futures. We'll go into. In fact, as a matter of fact, I brought in something. The question I brought in for futures, is it the futures? The question I brought in for the question I brought in for this is FX hedging with put call parity. So we are going to see this strategy, whether we are going to we'll be able to understand whether in the FX market there is put call parity, right? That understanding will not give you as a portfolio manager to understand, depending on what your objectives are. Like I always mentioned, objectives are important in every trade, what you want to achieve, right? Even the strategies that I explained earlier, you see that those different strategies are giving us different results. Some of them, you want to achieve high profits. Some of them you want to just make sure you buy the contract. Some of them you want to make sure that when you lose, you don't lose too much, depending on what your objectives are. But if you have the put call parity, it is giving you an idea of exposures in the market. By exposures, I mean chances of arbitrage. You understand? So these things will help you understand how you are able to navigate the market, make money, or protect yourself if you do your research properly, because all these decisions, all these computations, every strategy is based on research. If you go into the market properly, you cannot just go and start doing anything. You have to do a proper research. There's what we call fundamental analysis. There's what we call technical analysis. That is not what I'm teaching you now, but I'm going to explain it. Technical analysis is when you have to understand charts, you have to understand graphs, all those things that you see on the stock market movement and all those things. You have to understand your time, what was it called? Timing, yeah? You have to understand the timing. There are different tools, trading tools that you need to use to understand whether the market is going up or the market is coming down, and you have to set all those things up, right? That is technical analysis. Fundamental analysis is every other thing apart from technical analysis. What do I mean? Fundamental analysis affects, it concerns the economy, it concerns security, it concerns it concerns religion, it concerns everything you can think of. Do you know why I'm saying it concerns everything? Because anything can destabilize or stabilize the market. Anything can make the market go high, it can make the market come down. You understand? I'm deviating a lot now from what I'm teaching, but I think it's important that I tell you this thing. So, for example, Donald Trump might just come out and say something, and before you know, the whole market is crashing. You understand? Tomorrow, the Pope might come out and say something, and it might affect the market. Tomorrow, Israel might just throw one bomb to somewhere, and it will affect the market. Two countries might just say one thing, and it will affect the market. So everything that concerns our life, our social life, our well-being, even people, rich people, influential people, the likes of Elon Musk, Bill Gates, and all that, they can say things or make some kind of strategies that will affect their companies, and because they have a significant share in the market and all those kind of things, it would affect other stocks too and things like that. So know your strategy, do your research, and know what you want to hedge. You get? So who asked that question? You have succeeded in taking me to where I don't know, but let's go back. Thank you for asking. It's good. Baker. Okay, so where was I? So I was trying to explain this. So there is this part. there is this part of the question, right? Of the formula. So this part is talking about the future value, and sorry, the present value. You know, you have the future value, which is what you have agreed based on your forward rate, based on your forward contract, right? Excuse me. That's what you have agreed based on your forward contract. Now, we are now saying discount it to the present value. I'm sure everybody here knows how to discount. If you don't know how to discount, please leave my class. I'm joking, but please, you need to know how to discount. I'm sure everybody, in fact, I'll bet it that everybody knows how to discount. So you are discounting, because I don't want anybody to ask me a question of how did we get that value or this thing where we are solving, or if we need to discount anything. So if you are discounting, usually the question, they will give you the risk-free rate, right? So that's what you use to discount. It can be interest rates. Yeah, the risk-free rate is usually the interest rate, sorry. So yeah, they will give you the risk-free rate if you need to discount. This class is depleting 48 people. Am I taking too much of your time? Some of you can't wait to go and sleep. It is well. If it's only 2 people, self, I will teach. So that's what this part of it, of the question, of the formula is. That's what this part of the formula is. So the other one is so we have looked at one part of the formula. Now look at this formula. The formula says the present value of the future, the future price, right? That's one part. It should be equal to, so we have now finished with this part. I'm going to this part. If instead we buy a call and sell a put today, right? Now, when we're discussing the synthetic forwards, right? You know, we talked about this part where we looked at the difference and all. We are saying, okay, you are positioning yourself like you are using the option strategy to position yourself like a put option, right? So like a forward contract, right? So now this is the forward contract part of that synthetic forwards that we looked at earlier. So if this is the forward contract part, we want to look at the option part, right? This is the option part, right? So now we're saying if instead we buy a call, so if instead of using the forward contract, right? If instead of using the forward contract, we buy a call and sell a put today to guarantee the purchase price for the index in the future, the present value of the cost is the net option premium for buying the call and selling the puts. So what this part is talking about is this $19 here. So this part of the formula relates to the option, the premium option premiums that you purchased, right? It relates to the option premiums that you purchased. I don't know why I'm indulging too much this night. The option premium that you purchased. So the call option minus the put option. That is that. Plus the present value of the strike price. So this is the premium, call option premium minus the put option premium plus the premium of, plus the present value of the strike price. Denote the premiums of the option with strike K and T. So equating the cost of the alternative ways to buy the index at time T gives us this. So everything I've done here is just to try and break down each part of this formula for you so that you understand what we are talking about. Now, the first part of this equation is present value of the future, of the forward price, right? Present value of the forward price discounted using the risk-free rate should be equal to the call, right? It should be equal to the call premium minus the put premium plus the present value of the strike price. Remember from what we looked at earlier in these synthetic options, right? The strike price here is the same thing. So you that is going here, don't forget the objective of this synthetic forward. The objective of this synthetic forward is to make sure that you buy the option, but you are not using a forward contract. So this call option and this put call parity is now saying that if we discount the future value of the forward contract to today, get the premium of the put and the call, do the net, the plus and minus, the minus of the call and the premiums, right? We get it, plus the present value of the strike price, which is 1,000 in that example. If we do that and add it, it should be equal to the present value of the future of the forward contract. Why am I mentioning future too much? Of the forward contract. This is the formula of the put call parity. Is anybody still confused about any part of this equation? Dragging it, remember I've dragged this thing from here, from everything that I have explained here. Go up, sir, go up, sir, go up, sir. It's not going up. Okay, let me drag it from up. From everything I have explained here, what's happening? Why is it not coming down to me? Let me get my mouse. Hold on. So I can be scrolling easily. Oh. So if you look here, oh God. So everything I've explained here, everything I've explained in these synthetic forwards to is what I want. To here, I have tried to link them up. Is there anybody that don't understand? Everything I've explained from synthetic to this forward, to this place, I've tried to link them up. You know, the synthetic forward, we are saying that you are not using the forward contracts. Rather, you are using options. You are using options to position yourself like you are using a forward contract. So now we are saying that if you use options, which is this side of the, no problem, I can hear you, Bolandi. If you use options, if we use options to trade, right? We use options to trade, and we have our forward price that we have agreed. It should be, we have our forward rate, it should be equal. So if the present value of your forward price is equal to the premium of the call minus the premium of the put plus the present value of the strike price, if it's equal, then it means that there is a put call parity, which in broader terms explains that there is no opportunity for arbitrage in the market. It means that there is market. It means that there is equity in the market. So it means that whatever you are, if you are looking at the put call parity for a particular commodity, and you do this formula, then it means that if you go to the US market and trade, you will get the same results that you are getting in Nigeria. That's just the bottom line of it. Right? Am I making sense? Respond. We'll still use an example to explain. Okay.
So by the time you take like terms, right? This is what you should get. So I believe this part of the equation is very simple, right? Because if you just take like terms, so it means that we are moving this PVK to this part, right? So it becomes PV, the present value of the future contract, of the forward contract, minus the present value of the strike price, which is what we have here, should be equal to the call premium minus the put premium. So now let's look at this example. This is just what every notation in that formula means. Call KT means the price of the European call. We discussed the European call, the European option, the American and the Bermudian. So I'm sure everybody understands what I mean by European call, European put, and all those kind of things, right? If you don't recall it, go back to your notes. Go to the top of your notes, it's there. The put, right? So the put KT is equal to this. The spot price. Now I told you that the spot sometimes the formula can be different, right? So let me open Google here and just put call parity. Let me see, put call parity formula. Put call parity formula. It might show you. Usually, I think it's what would be, usually Google or any other thing will just give you the spot option and spots formula. Let me see whether that's what they will show us. Okay. Put call parity spots. Let me do spots formula so you guys can just see it. But all these things that they are showing us here is the spot formula. This is it too. This is it. I think this one here, this I believe is it. It's the same thing. So all these formulas are the same thing, yeah? You see where C is the price of the European call option, PVK is the present value of the strike price, P is the price of the European put option, the price of the option. This P here is the put option premium. This C here is the call option premium, right? S is the current spot rate. Exactly. This is what I was looking at. I wanted you guys to see. S is the current spot price of the distance. So in the formula that I'm giving you, you replace this FTO with S. You know why? When we talk about spot price, we are talking about the price now. However, from the perspective I'm explaining to you using a forward contract. And you know the forward contract is the price in the future. So by the time you do the forward, you do the present value of the forward contract, you are looking at the spot price. Does that make sense to you guys? Because you are discounting it to today, and the spot price is usually the current market price of that asset. So this S should replace this in this formula. Yeah, and you are fine. That was what I was trying to explain to you guys. Did I explain or confuse somebody? Hello? You guys are dozing off. Oh. I hope I'm not talking to myself. If we are tired, I can go.
Okay. We are not tired. Please, can you come back again, sir?
We are not tired.
Okay. So what I'm saying is, I explained this put call parity formula to you. This is what I explained. And I just told you that this, you can rewrite it to this. You can break it down to this, right? By just taking like terms, right? Now, and I told you that in case you are looking at another textbook and you see a different formula from this, it is still the same thing. I mentioned it earlier. And then just to buttress on that point and to make it clear, I went to Google here and I searched for put call parity formula, spot formula, because the one I'm giving you is the forward rate formula, but I'm telling you that it's still the same thing. It's the forward contract formula, or you can say the forward rate formula. It's still the same thing. Why is it the same thing? If you look at the spot formula here, right, this is the formula that they gave to us. Now, if you look at the formula, they say where C is equal to this, C is this C is the price of the premium of the European call option, which is the same thing as the premium of the European call option, right? P is the price of the European option, which is the same thing as the premium of the European call option, or the premium of the European put option. Now, if you have S, they say S is the current spot price. Now, I'm not explaining how this S, being the current spot price, relates to this present value, because I told you that that S will replace this thing that I highlighted here. And I'm explaining to you why S will replace this. And I'm telling you that S will replace this because I am explaining my notes that I'm explaining it from the point of a forward contract. And with a forward contract, you are looking at the future price, right? You are looking at the future price of that asset. Now, when they say the present value, you are discounting that future forward rate or future forward contract price, the forward contract price in the future. You are discounting it to today. So, because you are bringing it to the present value, you use the risk-free rate to discount it to today. So, if you discount it to today, it is the same thing as the spot price, because your spot price is the current market price. Wow, my system is very low. Did that make sense there?
Yes, sir. Yes, sir.
Okay, that's what I just wanted to clear that. Excuse me, let me get my charger, please. Wait. And I'm with you. Okay, so guys, I'm back now. So that's just it, right? So you look up all this and look up all this. We are good. So let's look at, so in other words, the present value of the bargain element from buying the index at the strike price, the right-hand side of the equation, must equal the initial net option premium, right? The equation above is known as the put call parity. So this is the formula for the put call parity. It is this simplified to this, right? So let's look at an example. I don't think I'll be able to teach futures. So I'm going to leave futures for you. Read futures. We'll continue with it for the next class. This is already 11:23 and I'm exhausted. So let's solve these two questions that is here. So consider buying a 6-month 100 strike call for a premium of 93. So you bought the call, right, for the premium, for this premium, right? And selling the 6 month 100. So you can see the strike price for these two is the same. So you know that you are looking at a synthetic forward, right? Is the same. So you are looking at a synthetic forward. So this minus this transaction creates a synthetic forward, permitting us to buy the index in 6 months for 1,000 because the actual forward price is. So now they are now telling us that the actual forward price is 1,020 naira and $1,020, right? So we have a forward price of $1,020. Now, what are we going to do? We need to discount it, right? We need to discount it to bring this 1,020 to the present value. This synthetic forward permits us to buy the index at a bargain of $20. So how did we arrive at this bargain of $20? Who can tell me how did we arrive at the bargain of $20? Hello, it's on the screen. Okay, for the sake of time. Now, if you look at the forward contract says our this thing is 1,000 this thing, right? Is the option, the strike price for the option is 1,000, whether the put or the call is 1,000. The forward, if we were to use a forward, if we were to use a forward contract, we will be buying that asset at 1,020. So 1,020 minus 1,000, it means that we have bought it for $20 less because we are going to use a synthetic forward and not a real forward. Does that make sense? Good. Okay. That is good. Now we know that the option premium here, if you look at this premium here, this 93 minus 74. 93 minus 74. We've already done it here, right? So we have 19.6. Now, this $20, which is our bargain, if we discount it at a risk-free rate of 2%, right? If we discount it at a risk-free rate of 2%, it will give us 19.612. So the difference in the option premium is also this thing, 19.61. So in this case, we can say there is a put call parity in the market. However, I think there is a problem with this example because they didn't state the risk-free rate. So this is how we can know that, because if you look at it, the present value of our futures contract, the present value of this futures contract, which is 19.61, is equal to the net value of our premium. And that is the same thing that this for this contract is giving us here. Normally, we should do the what the equation is showing us here, right? What the equation is showing us here is saying the present value of your futures contracts minus the present value of your strike price. What we did in this formula here is that we just say, instead of doing the present value of this and that of the future and of the strike price and the future rates and the forward rate, what we just do is net them off. Then whatever the net of is, do the present value of it. Is the same answer you arrive at, right? So whether you do 1,000 minus 120 and do the present value, or you do the individual present value, you should be able to arrive at the same answer. So in this case, we can say that there is a put call parity in the market. That means there is fairness, there is no arbitrage opportunity in the market. So in some questions they might throw up to you. They would ask you to check whether arbitrage opportunity exists in the market, right? And they will give you all these parameters. You just know that what they are trying to ask you of is the put call parity, right? So you just need to go and bring in your put call parity to check for arbitrage opportunity. So let's continue. I want to see if we can answer this question. Or should I give you this question as an example? Somebody answer me, maybe one or two persons. Should you go and attempt this question and we'll continue with it next week, or we should solve it here in class?
Let's go and attempt it, sir.
You go and attempt it, right? Okay, great. I like that. So a normal forward contract has, yes?
Let us solve it, sir.
Some persons are saying we should solve it. Some persons are saying we should.
Please. Let us solve it now, please.
That's the only question we have before going to the last topic, which is the future contract. So let's quickly do it once and for all, I beg.
Okay.
We know that by next
no
week we'll be
problem.
continuing with
Okay. So a normal forward contract has zero premium, right? No money paid up front. If a forward contract does require you to pay or receive money up front, it's called an off-market forward. Why? Because it is priced and is different from the current market forward price in option terms. So what they are simply saying is that for contracts you don't pay any premium, you don't pay any money upfront. But if that is the case, if you must have to pay, then it's called an off-market forward, right? Off-market forward contract. If you buy a call and sell a put with the same strike price and expiry, it's like creating a forward contract. But if the strike price is not equal to the price, then this is an off-market forward. It has non-zero premium. So let's look at this example. I think I might need my Excel here. So this example says a Nigerian company expects to receive 1 million. 1 million, which currency is this? Is euros, right? To a supplier in 6 months. The current spot exchange rate is 1,600 naira per euro, and the 6-month forward rate is 1,640 naira per euro. Options are available on the euro with strike price 1,640. Maturity at 6 months. Now the call premium, so if you look at it, this is the call premium, right? Is 50. The put premium is 10, right? So we already know that put minus call is equal to 40 naira per euro, right? The risk-free interest rate in Nigeria is negligible, so discounting can be ignored. Required: verify the put-call parity relationship using the given data. Are we ready? Are we ready?
Yes, sir. We are ready.
Okay. So, in this equation, my back is itching me. So in this equation, I am going to use the formula that I showed you from Google. This formula here. Right? But we are going to ignore this present value part. Do you know why I'm ignoring this present value part? Instead of bringing this PVK, I'm just going to bring in the price of the put option. Do you know why? Do you know why?
Because of the spot rate.
Hello? Yes?
Is it because of the spot price, sir?
No. Because this question has stated it clearly. They have stated it clearly. Can you read what I highlighted? Can you read what I highlighted?
The risk-free interest rate in Nigeria is negligible, so discounting can be ignored.
Good. So we don't need to do any present value thing in this form, in this equation. Do you understand?
Yes, sir.
Please, you understand, right? Okay, good. So if we understand that bit, then let's start bringing in our equations. So C.
Your screen is not visible, sir.
My screen is not visible.
It's no more visible, sir.
Eh?
Can you enlarge it,
Yes,
like
sir.
zoom in?
Wow. I'm surprised
We,
you're saying that.
we can see your screen, but can you zoom in?
Can you see the Excel? The Excel, because
Yes,
I've
I can
switched
see
to
your
Excel.
Excel, but if you can zoom in, it will be better. Okay, good. Thank you.
Maybe I should increase the font size too.
Yes,
Is this
thank
better?
you. Yes, thank you.
Okay. Oh, so let me just do that across. I think it's only this. It's only that cell that I did. I'm sure all those people that skipped this class now, they will be jumping into my DM asking me plenty questions. May God give me strength. I'll answer them, but if I don't have strength, we'll see next class. Okay, so let's pick our values. C is equal to how many? C is equal to what? 50, right? Because if you look at it here, they say C is what from here? Where C is the price of the European call option, and the price of the call option from what we have here, call option, which is the right to buy, the price, which is the same thing as the premium, right, is 50 naira. Am I correct?
Yes, sir.
Do you agree with me?
Yes, sir.
Okay. So the next thing we have is P. I told you forget about discounting anything, right? So P is equal to 10, right? So I'm going to come here and say this minus this, right? Do you agree? So from this, from what I've done now, this part of our equation, is equal to 40. Let me see if I copy it and paste whether it will stay. So I'll remove this, is because we are not doing present value, right? So this should be C minus P, right? Because that's what the formula should be telling us. It's not plus. I understand what they are doing here. Normally this, okay, I get. This should be based on the formula that I gave. This should have been transposed to this. So it's supposed to be your spot rate minus your PVK, because this is your spot rate, assuming it is the forward contract, is supposed to be discounted down to get this. This S is the same thing as this as the present value of the future and the forward rate. So the P that we are looking at is actually this. And if we move this to this side, it becomes a minus. That's why we have C minus P. Because I know that will be the next thing you guys will be asking me. So C minus P, 50 minus 10 is giving us 40. So this is one part of our equation. Do you get? This is one part of our equation. The next part of the equation will now be equal to, next part of the equation will now be equal to, let's look at the question. Okay, we have the premium. The premium is what we have looked at. We have the strike price, right? The strike price, which is our K, is what? 1,640, right?
Yes.
Are we together?
Yes, sir. Yes, sir. Yeah.
Our K is 1,640.
Yes, sir.
Okay. So I'll come here, I'll put K is equal to this. So the next thing we look at is S. S is our forward rate or our spot rate, right? S is our forward rate or our spot rate. So let's pick that from this question. So the current spot exchange rate is 1,600. So we have used the spot rate, pick it here, plug it in here. So, but the formula says what? Is S minus K and not K minus S, Abi? S minus K. Is that what the formula told us? That's what the formula told us. S minus K is your forward rate minus your future rate. You know what they are doing here is a plus, but the one that I'm working with is transpose, right? Do you get? So if that is the case, this becomes a minus. It becomes a minus. So we have this. Is this equal to this? The answer is false. So this false means that in the market, there is no put call parity. That's what it means, that there is no put call parity. So there exists an opportunity for arbitrage to happen in this market. So now I'm still going to give you this as an example, as an assignment. But what I want you to do for me, in this assignment is to go to this question and solve it using my example, my formula rather, where you have the forward rate minus the strike price. But don't forget, you are not discounting, right? So go and do that. I can still do that and still arrive at 0, but it will be, I will still arrive at false, but it will be different answers. But I don't want to do it. I want you to go and do it. So this is our situation. So it means that there is no put call parity in the market. It means that we have an arbitrage situation present in the market. So people can make outrageous profits if they are able to see the loopholes in the market in this trade and exploit it. That is what this put call parity situation has told us. Are we okay?
Yes, sir. So, sir, we should just take our current spot price, as in the current spot exchange rate. We should use it in replace of our PVRB.
Yes, you can do that. You can do that.
Sir. Okay, sir. Okay, sir. Okay, sir. Understood.
Faith Cookie is asking, can someone drop the? I just got it from Google. You see, I did not. Faith. I did not. It's the same formula. The only thing I've been explaining it from the beginning is that based on the parameters that they give you in the question, based on the values that you have, you just have to know which formula you are applying and how to tweak it, right? Know what is what and what is not. So this formula is the same formula that I used to arrive at my answer here. The only difference is that the question said that we don't need to discount. So they did not give us risk-free rates. You understand? They did not give us risk-free rate. They say we do not need to discount. Maybe I will look for other put call parity questions and put for you guys. So Esther has even gotten a question for you, a formula for you. But this formula, we are still going to look at put call parity extensively, right? It will be coming up, and the formula that somebody dropped now, I will explain it. But for now, understand this one first. So this is very simple. It's very simple. Go and work on it. Give me feedback within the week. This is 23-28. For those of us that are going to work or whatever we are doing tomorrow, I wish you a successful week. I'll see you next weekend on first day of next week. Have a blessed week. Take good care of yourself, and let's get ready to smash ICANN. God bless you.
Thank you, sir.
Thank you very much.
Thank you, sir.
Thank you, sir. For the lectures.